Hi, I'm Rob.
And I'm Rob.
And this is Ask Rob and Rob.
Welcome to Ask Rob and Rob. It's the show where we answer your property questions. And the show, of course, starts with you. So we like to make it really simple for you to send your questions our way.
We do. Head over to propertyhub.net/ask. That's propertyhub.net/ask. There, you can leave us a message. You can call us and leave a voicemail if you prefer. Or if you want to write in with your question, we have our wonderful column in the Sunday Times each and every Sunday in the home section. So if you want to get your question in that way, you can as well. First up, we've got a question in from Craig.
Hey, Rob and Rob. Super excited to be making the first contact. After years of listening to you on the podcast, after reading all your books, listening to all the audio books, and just being a super fan in general of property and of yourselves. So I've had analysis paralysis for years. Living in the southeast, not being able to invest. And so I've done nothing with it. But I'm now with my partner, whose property we live in. And together we have £30,000 saved. Now, in my position, what would you guys do? Like, what would be your advice? Would you invest that into a buy-to-let in a lovely place like Derby or Manchester in the play locations that you guys advise? Or would you save it up more? Or what would you do? I'd just love to hear your thoughts. I hope to hear from you. Thank you.
Craig, thank you for being a super fan and listening to all the audiobooks and the podcasts and so on. How can we not answer your question? Well, the answer is we have to, so let's do it. You're in an interesting position because you've got enough money just about to invest in property. £30,000 is a lot of money. Of that £30,000, it won't all go into property. So let's say you've got about roughly £5,000 for costs and a little contingency fund. So you put £25,000 down as a deposit. You get a 75% loan to value property. That would then allow you to buy a property worth £100,000. Now, for £100,000, you're not getting anything, certainly in Manchester, anywhere near the city anyway. And if you can find a property for £100,000 or less in the Manchester region, Greater Manchester, it's probably not the type of property you want to go for. It's going to be one of the cheapest properties in the whole of the region. Derby, there will be a few more options because as a city, it is a bit cheaper, but it still is down the cheaper end. So of the two areas you're looking at, Derby would be the one more attractive to me because something we've said on the podcast over and over is try and buy the best property in an area that you go to. Don't try and buy the worst property and hope that it does well. And the reason for that is the best areas stay the best. So if you can find something in Derby that's considered a good area, it will probably be considered a good area in years to come. If you're investing in an area of Manchester that's considered a bad area, it may become good, but it's something dramatically got to change, and that will really hurt your capital growth. So should you save up some more money? That is the key question here. Or should you pull the trigger and go for it? Well, I would say that depends on how long it's going to take you to save. So if you said to me you could get another £10,000 together in the next year, I would wait. And the reason why is that £10,000 leveraged can get you another £40,000. So the difference between a £100,000 property in Derby and an £140,000 property in Derby is huge. So it will make it a big difference. But if you were to say to me that it's going to take you another 4 years to get £10,000 together, then although it may not be the ideal property, I think the learning, the experience and some rental return and hopefully a bit of capital growth would possibly push me into investing sooner. I'd not want to wait 4 years, but I would wait 12 months for the right property. So it's that balancing act. It's knowing your savings rate, what's possible, and making that decision. But remember, with leverage, it's not 10,000, it's 40,000, and so on. You just multiply the numbers because of the leverage. That's why every penny that you save up will make a real difference when leveraging. So look at your savings rate, look what could be done to accelerate that saving over a short period, and try and push that a little bit further if possible. But if not, you've got an idea of what to do. Good luck.
Okay, great advice there for Craig. Let's move on to our next question.
Hi, Rob and Rob. Do you think that house price to earnings ratios will ever go back to historic levels? Or are the current levels here to stay due to factors such as more women in the workforce than before 1995? And if they were to go back, do you think this would be down to wage inflation or a house price crash?
Andrew, thank you for your question. And It's an interesting one because people always look at these historical house price to earnings ratios and go, oh, well, because they're so much higher now than they used to be, that means we're bound to have a property crash. It's just a matter of time. And that's the reason that you've had some people sitting out of the market ever since 2008. Even after you had the crash, people believed that it hadn't crashed far enough, and therefore things were only going to get worse. Obviously, a giant mega crash could happen. Nobody knows. But I think this focus on house price to earnings ratios is missing a lot. And for me, the major thing that it's missing is the lending market. Because even if you put aside supply and demand and interest rates and everything else, if the mortgage market allows people to borrow higher multiples, then that will naturally, in the face of constrained supply, push prices up. So really, the only thing that could bring multiples back to where they were in the early 1990s is a complete hard change to lending criteria, which would instantly see prices come down because it's the only thing that could happen. Well, is that going to happen? Well, for a broad range of financial and political reasons, it seems exceptionally unlikely. Therefore, the answer to your question is no. I don't think they are going to go back to where they were. That doesn't mean that they're not going to come down from where they are, though. And in fact, they have already come down because we've had this silent crash where property has been pretty much going sideways while inflation and incomes and everything else have been going up. So that is bringing the ratio down. But like I said back at the beginning of this answer, I think that ratio is incomplete anyway. It's certainly incomplete when people use it to say, oh, well, look how impossible it is to buy a house. It's like 6 times your income or whatever. Well, it's not, because in reality, anyone who's buying a particularly expensive home by first-time buyer standards is going to be doing so based on 2 incomes rather than 1. But also, it's only one way of evaluating the price of an asset. Recently in the podcast, we looked at price to rent ratios. So this is like the property equivalent of price to earnings that you use in stocks. And we saw that in terms of price to rent, property prices right now are cheaper than they've been at any time in recent memory, including being even cheaper than they were at the trough after the last crash. So I think the summary here is you could use data to say anything that you wanted to. You can always find a data point to support whatever argument it is you're trying to make. So I think it's a really interesting question, Andrew, and thank you for asking it. But I certainly wouldn't let that data point alone affect your decision making around investing.
So that's just done for another week. Thank you for listening, and hopefully you will join us again on Thursday for the Property Podcast. And if you're really keen, you'll be opening the pages of the Sunday Times on Sunday to see us answering your questions there. Until those wonderful events take place, take care, have fun, bye-bye.
Bye-bye.